This program is the second iteration in a series of virtual webinars, which we've entitled Coronavirus, What It Means for U.S. China Economic and Trade Relations, in which we invite 4 members of our Track 2 economic dialogues, 2 from China and 2 from the United States, to elaborate on different aspects of how the current pandemic is impacting the bilateral economic relationship. Now on to our 4 fabulous panelists. In the interest of time, I will only briefly introduce our speakers, but I encourage you to read their full bios located on the event page of our website if you're interested in learning more about their really impressive backgrounds. Xu Gao is Chief Economist of Bank of China International, leading the Research Institute and the Sales and Trading Department of that institution. Tu-Xing Tran is Dean and Professor of the China Institute for WTO Studies at the University of International Business and Economics. Barry Naughton is Professor at the University of California, San Diego, and one of America's outstanding analysts of Chinese economic policy. Last but certainly not least is Dan Rosen, who's a founding partner of the Rodian Group and also one of America's leading experts on China's economy. On Monday, he, along with the National Committee, released a report on U.S. China investment trends, which is also available on our website. Dan, I should note, is a National Committee board member. So let me turn it over first to Dan to make some remarks.
Thank you, Steve, and hi to everyone listening in today. It's great to be back together with our colleagues in China, in Beijing, and good evening to them. This Track 2 plays an important role at a people-to-people level in U.S.-China economic relations. It's been going on for a long time, and it's times like this, the mess that we're in right now, where these things can have some of their greatest value. I'm going to offer 3 quick thoughts to share my view on important aspects that shape the U.S.-China trade dynamics and outlook right now in the midst of the virus. First, a comment on surface politics. They're superficial, but they've never been this toxic in my 28-year career, and I don't think anybody else, my seniors and mentors, can remember a time when things were more toxic than they are either, even arguably during the Tiananmen debacle in 1989. I don't think there was quite as broad a sense of things going off in the wrong direction as we feel across the board right now. It's really quite serious on the surface in terms of political incentives, not least on the American side, to point to China as something to blame for the situation we find ourselves in. Second point I want to make, the short-term fundamentals below the surface, less superficial than the politics, are also not great. All indications I can look at right now in terms of the short-term economic outlook suggest that there is not the capacity at present for China and the United States to fulfill the ambitions laid out in the so-called Phase 1 agreement signed on January 15th. That's as close as we've come in recent years, having some sort of strategic resolution to expectations for the outlook for the bilateral relationship. And yet, given demand conditions in China and the United States, supply conditions in the United States, even, for example, with China short on pork right now because of African swine flu, American meat packers are not really in a position because of the virus to be a part of the export boom to meet China's needs, for instance. So there's both very micro problems that make it difficult to fulfill the export ambition, growing from 2017 levels, U.S. exports to China by $70 billion more at the margin this year, which is what the deal implied. Just not physically possible right now. Adding to the micro reasons for that, the microeconomic headwinds, At the most macroeconomic level, what we have presently is that the United States is at the large end of global efforts to stimulate through monetary and fiscal support, federal action to stimulate economic activity, where China, somewhat surprisingly, given their ability to stimulate last time we had a crisis a decade ago, China is sort of at the fairly thin end of leading economies in terms of its stimulus thus far. I would say the evidence suggests they won't be able to stimulate nearly as much this time as they did last time around. That will tend to reduce China's ability to be a big net importer at a time like this relative to what expectations were. Third point I want to make, beyond those short-term fundamentals of these cyclical problems that we have right now, and most important to us as economists, and we come to this dialogue as students of economics, are the structural drivers that shape the potential for US and China to find a way forward, constructive way forward in terms of their economic interests. The structural drivers, or in my opinion, the lack thereof right now, which is to say that my point of view is that China has not been able to implement its ambitions for reform and opening in the past 5 or 8 years because of the challenges to domestic stability in China from trying to do the next set of necessary reforms. There are a few green shoots right now. We've heard a few signals that sound kind of promising out of the State Council and the Chinese leadership over the past few months. For example, implementing a new market allocation set of regimes for basic factors of production. But let's face it, an emergency, an economic emergency like the one we're in, is never the right time to try to do the hard work of reform. The hard work of reform needs to be done during the good days so that when the bad times come around and governments are not in a position to take bold reform steps, we already have a good foundation of compatibility in our systems. And even if really bold things are put on the table at the National People's Congress that starts to sit next week, I think it'll be years before we'll have verifiable results of that will help us to change thinking and policy planning in Washington. Meanwhile, on the US side, right now, the general mood is definitely not optimistic about reform in China. It's so pessimistic, in fact, that the Trump administration is basically reform agenda and to do managed trade arrangements to deal with its objectives with China, which is what the phase 1 deal was. That leaves us with essentially divergent paths on a structural level between our two economies. And I dare say some of others in the OECD world share that concern that the long-term direction that China's system is presently taking is not convergent with or compatible with market liberal norms as we once hoped China was finding its way toward in the long run. And that is the fundamental problem that we grapple with in our times here, I would say. Thank you, and I look forward to the conversation with my colleagues.
Barry, just go directly to you.
Hi, yeah, let me come in. Hello, everybody. It's great to see some old friends, and hello to our fellow economists in Beijing and listeners in Beijing. First, sort of underline what he said about politics, and then make 3 sort of separate but related points. It is absolutely true. I mean, the political environment, probably in both countries, right, is more negative than it's ever been. I think certainly in the United States, and disappointment with China. And I think probably people in China feel anger and disappointment with the United States too. So it's a really a toxic brew. And in terms of what we're talking about today, I think we need to recognize that the election is coming up in the United States. It's quite clear that the Republican Party is going to run against China and against Democrats for being soft on China. The Democrats are going to try and hit back and say they're not soft on China and that the Republicans are. And so that produces this tremendously unpredictable element. So as we try and think about what how the economic relationship is going to evolve, we should keep in mind that on any given morning, President Donald Trump could wake up and disrupt, but could also strengthen the relationship. It's just extremely unpredictable, and we need to be aware of that. So 3 points. First of all, yeah, there is a trade deal on the table. And I certainly agree with Dan. Probably in concrete terms, it's not achievable. But the big question in my mind is, will China make a significant effort to step up the purchases it makes from the United States? We were surprised last week. Liu He and Lighthizer spoke on the telephone, and Liu He said, no, we intend to fulfill this. Very interesting. If true, it might have an impact. So far, we haven't really seen much action there at all. And this is really a case where, it's not going to be enough for the Chinese government to just say it's okay to buy American soybeans again. This is a managed purchase arrangement, as Dan said. And so it's really going to take a significant effort, clear and coordinated action on the part of the Chinese government. And is that going to happen? We don't know. I think probably the consensus here in the United States is that it's probably not going to happen. So this is an opportunity for China to affect people's perception by some kind of significant and decisive action, if it were to happen. I think it's fair to say the ball's in China's court. It's up to them to decide whether they want to act in that way. Now, if we think about whether or not the Chinese government can act, we have to recognize there's still an enormous amount of economic insecurity. China's way ahead of the United States in terms of recovering from the virus. It's way ahead of the United States in terms of going through the worst of the economic crisis and now recovering somewhat. But it's by no means back to normal. And I think there's 2 areas in particular that we're concerned about. One is the small scale sector, the service economy, and the rural to urban migrant fueled economy, which is still well below its potential, still well below full recovery, and it's going to stay suppressed as long as people are afraid of close contact, which they naturally still are. This is, of course, a problem for both our economies. Even as lockdowns are eased, still people are afraid, and they stay away from a lot of types of activity. So in China, person-to-person services are still suppressed. A lot of migrants are still back in their home villages. There's still a lot that needs to be done there. And of course, global trade, if we assume that all of the advanced country markets are going to have suppressed demand for probably 6 months, maybe the entire year, who knows? It depends on the course of the disease. That means that sector of China's economy is also going to recover slowly. So China still faces a lot of economic drag. And that means something politically as well, because obviously every government, including the Chinese government, including the U.S. government, is going to have to look to their own domestic constituencies first. For China, that includes farmers. China has to support farm income. You've got 200 million migrants who normally would be in the cities, most of whom are still back in the village. So politically, is China going to be able to make massive purchases from the United States at the cost of, to a certain extent, of domestic interest groups? It's hard to see that. It could happen, but it's something where I think everybody's taking a kind of skeptical wait and see attitude. And as Dan said very clearly, we know, people who follow China know that there's a set of new reforms going on, but to be honest, we don't understand them. We don't know what concrete manifestations are. So our view of China is very much driven by what the Ministry of Foreign Affairs is saying in their public meetings, and that's not good, and we don't really like hearing it. So the relationship, of course, even the economic relationship is multidimensional. And what we're seeing now in the United States, you know, the combination of the security and the health related are really leading to this.
Harry, you're breaking up. I'm not sure why.
Rollback globalization way will be not only pressures but legislation.
Barry, you're breaking up and not coming through.
Looks like we lost him, Steve.
So technology. So probably the best thing then is, because we've lost
perfect Barry at home.
Are you back, Barry? Or else we'll go on. Okay, so continue on then. And if we lose you again, I'm going to go to Shugao.
Perfect. I'm almost done anyway. Let me just wrap up by saying we should expect some kind of legislative initiatives that will require both IT supply chains and health-related health-related supply chains to maintain more resilience and more domestic production. So that's also going to push against the U.S. China relationship. So there are a lot of headwinds. It's hard to be optimistic, and we need to keep talking about what the next steps will be.
Great. The part we heard was terrific. Let's go to Shugao now before we go to questions.
Okay, hi everyone. It's my pleasure to be in this very interesting panel, and I will talk about the implementation of the Phase 1 trade deal, and I'm going to show you some, I will use my PowerPoint to show you some charts. That the most important part of the Phase 1 trade deal is the increase of China's imports from the United States by $200 billion in this year and next year, on top of the 2017 baseline. And most of the increase is in the trade of goods, and you can see that the increase. So the China's imports of the goods from the United States is supposed to increase by about 64 billion in this year, and to use that number, and we can estimate that China should have a very. I know you can't see the numbers very clearly on the screen, and so I will just tell you the story. And so, in order to fulfill the Phase 1 trade deal, China has to increase to accelerate its import growth from the United States dramatically. So the import of the goods from the United States is supposed to be about 80% in this year, in 2020, and the growth rate in last year was negative 21%. So you can see that the growth rate is supposed to increase by 100 percentage points. And in energy, the energy is supposed to import of growth of energy is supposed to be 525% in this year. And then we already have the data in the first quarter of this year, and we can see that the import of the goods from the United States grow by negative 3.4%. So that means in order to fulfill the goal in this, the import growth in this year, the growth rate needed in the coming 3 quarters, in the Q2, Q3, and Q4 of this year, of China's imports of goods from the United States is supposed to be 100% points, 100%, actually 104%, and the import of the manufactured goods is supposed to be 7%, which in the coming 3 quarters, and which was negative 14% in in the first quarter. So that means, that this chart shows the growth rate that needed for China's China's imports of the manufactured goods from the United States is supposed to be about 70%, and that is a high growth rate that we have never seen in the last decades. So, in order to fulfill that goal, to have the about 70% growth rate, I think the main problem is that does the U.S. has enough capacity to deliver that amount of manufacturing goods? Because we all know that according to the COVID-19 crisis, there's a massive lockdown in the lockdown of the factories in the United States. So that growth rate, that is, I think it is problematic. And the same pattern can be also seen in the energy imports. So energy imports is supposed to be at more than 500% in the coming quarters, and which is problematic because we know that the energy price is depressed in recent months. And for agriculture imports, the growth rate needed is about 200%, which is ambitious, but I think it is achievable. So the overall goods imports from the United States needed for the coming is about 100%, and I think that is very unlikely to be achieved in this year. So the main message I want to deliver is that given the COVID-19 crisis, the target set in the Phase 1 trade deal I think it is very hard, if not entirely impossible. It's very hard to be achieved. And you can see that that is mainly as a result of the shock that released by the COVID-19 crisis. And in this chart, you can see that the PMI of China has the first quarter and now has recovered somewhat. But the PMI in the US, EU, and Japan, and the PMI of the emerging markets has come down significantly and come to a very all-time low. And against that backdrop, that China has used its expansionary policy to boost up its domestic demand. As you can see here, that the China's total social financing has increased to a very high growth rate in recent months. And as a result of that, the dark line represents the estimated China's domestic order index. So China's domestic order has jumped to a very high level. But in the meantime, the new export order of China has come down significantly, as a result of the bad global economy. So the main conclusion I want to say that is after the outbreak of the COVID-19 crisis, the import targets for 2020 set in the Phase 1 trade agreement, well, is unlikely, if not impossible, to be achieved because time has lost due to the lockdown in Q1 in China, and time will be lost due to the lockdown in United States in Q2, maybe in Q3. And China's imports from the United States, especially in the manufactured goods, are facing capacity constraint in the United States. And in the meantime, China has successfully stimulated its domestic demand, which can help the world economy to recover. And the impacts of COVID-19 should be taken into consideration when the progress of the Phase 1 trade agreement is assessed. So I think that some kind of flexibility in the assessment of the progress of the Phase 1 trade deal, I think, is needed because of the COVID-19. So that's a point I want to make, and I will stop here and looking forward to more discussion later.
Terrific presentation, raises a lot of interesting questions. Professor Tu, let's see, while we're waiting for him to reconnect, let's go to some questions. Gao, you're basically asking, does the U.S. have capacity? So I guess my question for Dan and Barry is do we? If China had the market, and then a kind of a subsidiary question for Barry is, you were saying their cost to China's domestic suppliers in living up to this trade agreement. Isn't the cost predominantly paid by other foreign countries? So both of those questions for Barry and Dan.
So the question is whether the main constraint on getting anywhere close to the phase one deal targets is on the U.S. supply side, or is it on China's demand side? Or a third possibility, is it mostly about diverting China's imports that were coming from other countries to the United States? At least some of this deal, even before COVID, was going to rely on diverting imports China was previously taking from Australia and Indonesia in natural gas and fossil fuels, and for coal as well, to American vendors, displacing other import activity. I think that was inevitably going to be a big part of it. The agriculture expectations were built from a sort of business as usual 2017 vintage expectation about China's need for animal feed, which was profoundly disrupted, not by America's ability to supply, because most of that soybean is not labor intensive. It's big, there are big piles of soybeans waiting at ports that could be shipped most of the time. So that's not so much disrupted by the virus. And then, of course, the other giant factor affecting the outlook is Boeing and their ability to continue shipping aircraft in light of the 737 MAX problems that have befallen us. So I think most of the factors that are disrupting the expectation that the trade objectives are met aren't really virus driven, are made somewhat worse by the virus, but they're not really dependent on the virus, in my opinion. And then if Barry heard other questions, Steve, that you put to him, I'd be really curious to hear what he has to say about them.
Now we've got Professor Tu back. So you want to give your presentation?
Okay. Thank you for inviting me, and I'm so glad to see all these friends. I think I'm sorry with the problem with my network. I think we really need a 5G of Huawei. I would like to share some thoughts of on the prospect of U.S.-China trade relations. This relationship has been in tension since Trump's office in 2017. The basic logic of Trump's decoupling with China is that the U.S. has too much dependence on China, hurting U.S. industries and national security. We once hoped that the pandemic could create some opportunities for the two sides to show some goodwill to each other and initiate some collaborations as the world is fighting with such a great public health crisis. But it has turned out that when China was hit, the US government was looking on differently or even gladly. And then when the US was caught, the Trump administration was busy with passing the buck to China. So we have not seen any leadership by the US or cooperation between the two countries, governments in the fight with the pandemic. In fact, I would say that the pandemic has given Mr. Trump even more arguments that over-dependence on China or any other countries would hurt the US. So I don't see any possibility that the Trump administration will relieve its protectionist trade policy against China because of the pandemic, if not reinforce. On the China side, I don't see also don't see any willingness to reinforce trade cooperation with the U.S. either. Although the Chinese government are working hard to, as I know, to implement those, especially institutional commitments under the Phase 1 deal, it is simply, as former panelists said, it is simply impossible, I think, to fully implement those purchase commitments. More importantly, as Barry said, both sides should buy each other, I think. Actually, maybe on the China side, I noticed that China national TV has assailed Mr. Pompeo for continuous days. It is really extraordinary. Right now, I would say that the image of the U.S. might be at lowest point since 1979. So there is no expectation on the Trump administration to China. So I'm very pessimistic about the prospect of China relations under the Trump administration. The only hope maybe is he leave office next. He's right that I really hope that he will lose the election. That's my personal. But we don't have the capability to make this happen. So our hope is on or dependent on American. I don't expect another new president will be nice or soft on China. Just look forward to some rationality, pragmatism, and more importantly, Korea.
Professor, you're breaking up a lot. I assume that's true for everybody. We're not hearing you. So let me interrupt. Yeah, you're frozen. What's so interesting is in these track 2 dialogues, we always have to spend a lot of time working towards what we call a consensus, where the U.S. side and the Chinese side agree. I think in this panel, it's quite clear we do have a consensus, which is that implementation of the Phase 1 deal is not going to occur on time. I think it's each speaker kind of focused on that. So I guess my question for the panel is, okay, what should both governments do? What do we tell our governments that given we made a big deal of reaching this Phase 1 agreement, what do we do given the fact that we are not going to be able to implement it with both? I think the reasons fair to say are both. It's U.S. capacity and China market. Xu Gao, what do you suggest we tell our government? And Dan, what do you suggest? Because I don't see Professor Tu or Barry. Oh, now I see them both. But Xu Gao, what do you think? And then Dan.
Steve, I think that the Phase 1 trade deal is negotiated before the COVID-19 crisis and is signed before the crisis. And so it is clearly that when we set the target, when the two parties set the targets, they didn't take into account of the impacts of the crisis. I think that when we assess the implementation of the Phase 1 trade deal, we should take into account of the impact time to implement the increase of the imports needed, required in the trade deal, so that the low import growth in the first quarter and maybe in the second quarter of this year of the China from United States, I should be regarded as a kind of a default of the trade, and I think that that's the message we should send to the U.S. government and also send to the Chinese government. And as I show you in my chart, that the Chinese government has already used the expansionary monetary policy to boost domestic demand, and according to the data, then the domestic demand in China has already jumped up, and so that means that China has already used its policy ambitions to to boost the economy and to increase its imports from the rest of the world as well as from the United States. So I said we just need more time, given the outbreak of the COVID-19, to fulfill the phase one trade deal.
Yeah. Dan, what do you suggest?
Oh, so the problem with that logic is that the main role of the phase one deal was not to repair long-term U.S. China economic relations, but rather to get Donald J. Trump reelected. It didn't fundamentally address our long-term interests, to be honest, right? And the timing of it, delivering some big good news for U.S. exporters prior to November 2020 was essential to its nature. And so while economically it's completely correct to say there needs to be more time for that deal to generate any kind of results that could be called a success within the framework that the deal was promising, it's utterly unrealistic to expect half of Americans who are not supportive of the president to go with that logic and say, okay, yeah, it's still potentially the way forward. It just needs more time. Well, which is to say that Dr. Xu is absolutely correct. He's got the exact right economic analysis of what the reality, what the fundamentals are. We all do agree about that. But then coming up with something constructive to say that will help de-escalate the tension, I think the only thing I have been able to identify that would do that would be a surprising Chinese endorsement of liberal economic reform urgency on its own side that would change the international global conversation. Because remember, these concerns about where we're going are not just happening in Washington, they're also happening in many other market economy capitals as well. So that is the wild card that could get us out of the, but again, as I said, I think in the middle of this economic emergency, generally, you would say the political economy does not make it likely that that's the moment that China could really make a bold reform step forward. I hope I'm wrong about that.
Actually, we all know that the phase one deal has mainly two parts. One part is on these institutional issues. Another part is on the purchase commitments. So as Mr. Xu said, and also I agree that it's impossible for China to fulfill these purchase commitments right now. So maybe we need more time, but I don't think that's the main point. So I agree with Dan that we should maybe focus on these institutional commitments, which are more fundamental and structural. But I not so agree with Dan that actually I think crisis could create some urgency for institutional reforms. Actually, China's WTO accession in 2001, China was experiencing some economic difficulties. Economic growth rates were actually declining before 2001. Then this kind of economic difficulties created some urgency for the Chinese government to push forward harder reforms. Kind of incentive, also a kind of persuasive argument to push forward harder reforms. So, I think as Dan said, the outside world was not satisfied with the speed of China's reform in recent years. But you see, after a couple of years, China's economic growth has been slowing down, as we all know. But now, at least in the last 2 or 3 years, the speed has been up, has been increasing actually. So at least it's faster than the early years, like in 2013 or 2014. So, as I said, I think these economic crises or difficulties maybe produce some pushing force to the Chinese government.
Before going on to Barry, Professor Tu, give us some very concrete examples of rapidly in the last 2 or 3 years that you just said.
I think one area is the financial sector. Mr. Xu is specialist on this issue. Actually, as we know, China made some commitments in the financial sector openness, but it is true that the opening process was slow. It is true that it was slow. But you can see in the last 2 years, there have been very ambitious efforts to push forward the openness of this sector. Actually, many experts are concerned about the speed. They thought that it is maybe too fast. But I think the Chinese government is determined to do that. Another area, I think it's on foreign investment. Although the new foreign investment law is not maybe satisfying everybody, but we should admit that it is a great step forward. And also, actually, China has been good bilateral in with the EU and the United States. These negotiations are also creating some urgencies and incentives for the Chinese government to push forward these reforms that are opening up. So also another issue, I think Ben and also many other American experts have been talked about many times, which is the subsidy. Actually, as I know, many Chinese government bodies are working hard and seriously on this issue, systems, and make them more transparent and compatible with the international rules. So maybe the reforms are not the government is seriously considering to push forward some harder reforms.
Barry, you want to comment on this question also? We got to put San Diego on the grid.
Let's try this. Can you hear me now?
Yes, we can.
I'm also phoning in on an iPhone. Can your people patch me in? They should see iPhone input.
But we can hear you fine. So just.
Oh, you can hear me. Okay, good.
Yeah.
So, so with great respect for everything that's been said, everything I agree with, but I think we also need to completely distinguish between two different circumstances. One is that the Chinese government makes some very large and aggressive purchases, and the other where it doesn't. It may indeed be that China makes some large purchases and the U.S. faces some short-term supply constraints, especially in pork, especially in airplanes. That would be too bad. But look, when we get 6 months from now, if there are large unfilled orders from China, then it's going to be relatively easy to reassess the phase one trade deal. If there are not large unfulfilled orders, it's going to be completely a dead letter. Now, obviously that involves some risks on the Chinese side, economic and political. So it's not an easy decision to make, but I really think, yes, it's not realistic to assume the trade deal is going to be implemented as it is, but there are very different potential situations downstream if we think of two different types of behavior on the part of the Chinese.
That's a great point. Yes, it's a great point. It's taking an economic risk in exchange for political benefit. So talk about the onshoring that's likely to occur post-COVID and how that'll affect both U.S. China relations and the the bilateral trade deficit. We saw legislation proposed yesterday where they're going to give tax incentives to produce rare earth materials in the United States, where a lot of incentives given to kind of bring that home. We're obviously going to see incentives given to PPE producers to produce in the United States and be able to create a stockpile. How is that going to affect the economic relationship? I guess who wants to take that one?
Well, let me, while my technology is working, let me take a crack at that. I mean, when you start adding up these incremental measures, the incremental measures will certainly occur, right? Just exactly as Steve laid out, that there'll be a series of ad hoc measures and maybe some tax code changes. Of course, Japan has actually a fund to support reshoring by some of the Japanese companies. It wouldn't surprise me if that happened in the United States as well. So obviously that has some economic impact, plus it's a very unfriendly gesture to China. Still, the ultimate decision makers are companies, and China is still a really big market, and Chinese logistics are really very, very efficient and low cost. So, if we look at it purely in economic terms, what I would expect to see would be a reversal of the trend towards offshoring, but not by any means the massive reshoring of American investment and production chains in China. I mean, in part, one important thing, of course, is that a lot of U.S. production chains in China are actually run by intermediary companies from Taiwan or Hong Kong or Korea, and are not directly subject to American policy. So I think we could see a moderate reshoring trend, but if it triggers an even greater deterioration in relations, then it could spin out of control and be something much bigger, which would also be much more of a shock to the global economy.
Xu Gao or Professor Tu, anything you want to add on that?
Well, I think that it is true that the United States wants their factory to come back to the United States, but I think it's very unlikely in the next 1 or 2 years, because after the outbreak of the COVID-19, now the global world has fallen into kind of insufficient demand, so there's overcapacity globally. So you can see that from the deflation pressures felt by all the countries. And so if you want to rebuild factories in the United States, that means you have to invest. You have to invest a lot. You have to build new capacities in the United States, but that is economically it's not something that the factories or enterprises want to do in a world that is there with insufficient demand and overcapacity. So I think that after COVID-19, although the United States can use these policies to give more incentives for the factory to move back to the United States, but I don't think that will take place at very massive scale. But I think that kind of policy do send out signals that the United States want to break up with China, and I think that is harmful to the bilateral relation between U.S. and China. But I think that the U.S. China has come together and has linked for over 3 decades, for about 2 decades after China entered WTO, and the economic link between these two countries has become too intensive, too massive, and I think it is impossible to cut these two countries apart. So I think that politicians they may have their goals, but in the long term, I think the economic forces always triumph. So I think that despite all these headwinds, especially from the political side. I think China and the United States will continue to be linked, and I think that will be the long run trend.
Professor Tu, anything you wanted to add?
Yes, I agree with Barry that for companies, it is reasonable to reconsider the balance or the trade-off between the security and the efficiency of supply chains. So under such a big pandemic, some companies maybe need to reconsider their commercial operations. But since China has been very quick in controlling the virus, so then in terms of security, China is still one of the most safest place to arrange their supply chains. So, but another problem is if the government or the US government wants to push forward such kind of reshoring, then that's another issue. Actually, the trade war in the last 2 years has already created such kind of tendency or policy environment. So some American companies have to, or some, not only American, but also other countries' companies have to rearrange their supply chains with regard to China. So, but the problem is if the US government wants to achieve this at a very significant scale, then the US will become a very protective country. The US will give up its liberal trade policy at all.
Well, there's certainly, Professor Tu, there's certainly, as part of the legislation that's proposed, now obviously this is proposed legislation, it hasn't passed either the House or the Senate, and as Barry pointed out, the Japanese have already done this. It's effectively, the bill allocates 41 billion US to reshoring. So it's not a question, what the tariffs have done is basically gotten US companies to basically diversify their sources. So they've moved Vietnam, Indonesia, and other places where they're avoiding the tariffs. This does not do this. This actually requires that the producer brings the production home and benefits from these government subsidies, which is quite serious. Again, it's a proposed bill, but that's the concept, that you're willing as a nation to pay the price to have the supply at home and not be subject to things like COVID-19. Dan, you look like you wanted to say something.
Wanted to throw in a couple of thoughts on this meta topic of reshoring or sort of resourcing as well, right, to reduce perceived vulnerabilities. Number one, ultimately, yes, economic logic is the most important force shaping the structure of economic activity within economies and among them globally. But there's no better proof than China's industrial policies the past decades that if government wants to, it can very fundamentally change the outcomes in terms of which industries grow and which do not. In general, I think that's usually not such a good idea. And I point to problems in China today and debt that are the evidence of that. But if government wants, and government does want, and there are security considerations that have to do with health vulnerability now, to invest money in changing the way the economy works for these things like PPE, medical devices, it absolutely can do so, and it will, in not just the US, but Europe and elsewhere around the world. Also, secondly, that it's definitely not just an American phenomenon. Other areas, including Japan and the European Union, have really gone further to talk about reshoring or resourcing than Washington has gone so far. Third, that even before COVID, there was a lot of hedging of overdependence on China where there's growing political risk because of international tensions around the world. I will observe, we just did some research over the past decade. There's been more new manufacturing FDI going into ASEAN countries than there is going into China for the first time in 4 decades. So while there's talk about the new foreign investment law, which Professor Tu mentioned, it's, as usual, it's great to talk about it, but it hasn't been implemented enough to make the door open so wide that it has changed the pattern here. And the pattern is that people are diversifying away from putting their next plant in China and putting it in ASEAN instead, in order to have a little more diversification, a little less concentrated risk. The next phase of decoupling in America will be rationally cleaning up all the crazy ideas about decoupling from the past 3 years. In the period we just came through was just establishing the idea that, my goodness, we really could decouple. It would be hugely costly, but in principle, it's not impossible. Actually, there's nothing inevitable about our engagement. Our engagement is contingent on having convergent systems. And if we don't have convergent systems, then the engagement will not happen. In fact, it will reverse. We have now shown that. Well, when I say we, I mean the Trump administration largely. It has been shown to be reality and true. That doesn't mean that it's affordable the way it's currently been suggested doing it. In fact, it's not. And stockpiling something like rare earths would be much, much cheaper than restarting production in, I think, Mountain View, California is the facility which is most likely to take advantage of those tax incentives, for example. But it's very wasteful. We're in a resource-constrained world now, and there's going to be a lot of change in American thinking about engagement with China to be more thoughtful and smart rather than this sort of shoot first and ask questions later policy that we've had in recent years. Maybe a necessary phase, but definitely not the right approach to strategic policy making for the long run.
Wouldn't the same be true in addition to rare earths of PPE and other things? That the answer isn't necessarily to reshore it, but to create sufficient stockpiles in public and private hospitals throughout the United States, that if a crisis happens, we can deal?
Yep. I mean, there was backup capacity in Rhode Island to produce a certain volume of masks. And in a once-in-a-century crisis, there's never going to be adequate stockpiles and supplies because it's very unlikely that people anticipate these shocks the way they need to, unfortunately, which is why international cooperation is a necessary part of the solution here as well. But yes, Steve, I mean, there's a series of questions. Can you stockpile it adequately to meet your needs? And what's the cost of that relative to creating a subsidy or industrial policy or otherwise forcing producers to come back to your own shores? And we need to return to that kind of fact-based national policy making rather than this sort of belief-based, faith-based, emotive-based policy making.
Barry, anything you wanted to add on that, or we're good? You're muted though.
I'm not talking on the phone as well as on the direct program, so not clear. No, I agree with what people have been saying. I mean, the one thing that we can say for sure is that businesses are already adjusting their risk minimization strategy. So now a large business will think that there is an element of risk in operating in China that needs to be diversified against. And so just the question is whether we can find a stable point where the cooperation can continue on that reduced level.
Can we talk a little bit about capital flows and this recent instruction from President Trump to the Department of Labor, I believe, that then instructed the board of directors of a federal pension fund to stop investing in any Chinese securities? Dan or Barry or has anybody kind of looked at that and figured out what this means? Obviously, I think the pension fund would have invested in total, I think it was $4 billion, so it's not a big dollar.
Yeah. two-finger. Public pension funds, in my experience, feel that investing in Chinese securities would be toxic, and they don't do it.
I
CalPERS.
CalPERS does invest in funds which have exposures to Chinese securities.
Yes, but they don't do it. I mean, it's at a nice distance, so they have a certain amount of deniability.
But this is investing. In other words, you invest in MSCI, which has now defined Chinese companies as part of MSCI. So when you buy the MSCI index, effectively, what they've stopped now is the ability to invest in that index, which would have invested in Chinese securities. But Dan, you want to comment?
I wasn't saying stocks. I was saying government bonds and development bank bonds.
The larger issue, Steve, is driven by the decision of global index companies like MSCI, Russell on the bond side, FT, FTSE, and others, both in equity and in debt, to move beyond including offshore Chinese exposure to China's growth. Because that's what, if you're an index company, your job is to be apolitical and simply answer the question, where is growth in the global economy that investors could access? Because that's what a stock or a debt issue reflects, right? The profitability of companies taking risk to serve growth and demand around the world. And if a very large share of marginal global growth is happening in China, then companies servicing that opportunity are going to see their profits grow, and their securities, their debt instruments are going to be attractive to investors. And so there are fiduciary considerations. If you invest directly in those companies, can you get your money out because of capital controls, which in the past limited these indices to only including recommendation to access Chinese growth when those Chinese firms list offshore and are accessible as American depository receipts in the US or in Hong Kong or Singapore, London, that sort of stuff. The time had come for these index firms to say, because China has improved the convertibility across its financial account, we can now include direct exposure to Chinese stocks and bonds to global investors, professional investors that don't need to be told by a government board whether they should have this or that in their portfolio, frankly. And so these indices said, yes, going forward, there will be a larger weight of these Chinese securities in our standard portfolio that, again, doesn't reflect any political judgment about whether China or Saudi Arabia or anybody else is good or bad. It simply says, where's the growth, guys? What would you want to have if you wanted to have a perfectly balanced global portfolio of where the growth is? And that's what folks like MSCI did. It's their job. Their customers have all the acumen about political risk inside that they need, as do these government pension boards as well, I would say. But, you know, all bets are off if politics get to the point they've gotten now. All of this opportunity to be more deeply engaged is contingent on expectation that in the future we will be more like one another rather than less like one another. And that's where these fundamental questions about where China is planning to go in the future has disrupted the economic opportunities that we've been talking about for so long.
Professor Xu Gao, any additions to that?
I think that I want to make 2 points, Steve, on that. The first point is that China is not a country short of capital. Actually, China has excessive saving and lend a lot of its capital to other countries, including lend to the United States. So if the U.S. asks its institutions to not buy China stock, and the Chinese government can simply ask their institution not buying U.S. government bond, or even sell U.S. bond. So, and I think that will have that kind of, so selling U.S. Treasury bond will have much bigger impacts on the United States than the impact of the U.S. institution not buying China stock. And second point I want to make is from the financial point perspective, that that given the delinking trend of these two countries, actually the correlation of the China stock market, the China financial market, and the U.S. financial market has been decreasing, and so in order to, and that makes China's stock or China's financial assets a favorable assets to own. If you want to diversify your portfolio. So if you that means that for these U.S. institutional investors, they want to put the bigger part of the portfolio of the money on the Chinese financial market, and if you ask them not to do that, I think that is not good for them. That's not good for them, and I think that's the second point I want to make.
Great. Nick Lardy asks, given what has been said on this call about the lack of likelihood that the Phase 1 agreement will be implemented, what did Ambassador Lighthizer and Vice Premier Liu He talk about that gave them this very positive readouts from both the Chinese and American governments? Anybody want to venture a comment on that?
I mean, of course, we don't know what they talked about, and we don't know whether either one of them has buy-in from their boss, right? Is Donald Trump going to support what Lighthizer says? We don't know. Will Xi Jinping support what Liu He says? We don't know. I assume that both of them are trying to keep this alive, and the way to keep it alive is to tell both sides that there's progress, that there's stuff happening. But I would just go back to my original point, which is, in order to make this call realistic, China has to follow through with large purchases. And I think that's what Lighthizer is hoping for.
Xu Gao or Professor Tu, you want to say what the Chinese government said about this?
Well, I think that, in my view, I think that the Chinese government will reassure the U.S. government that China will try to fulfill the Phase 1 trade deal, and they just need more time.
I think Dan made reference to, Professor Tu, you want to add?
Yeah, as I said, I think the Chinese government will still implement those institutional commitments in the Phase 1 deal. Actually, in early February, some Chinese government agencies were already discussing whether we can implement those purchase commitments, because at that time, China was hit significantly by the virus. So, these purchase commitments, if we cannot implement those commitments, then we can use some provisions in the deal to argue that because of some outside factors like the pandemic, then we cannot make this happen. But it is not inconsistent with the deal, because it's already in the deal. We should consider those uncontrollable factors. So then in this sense, you can still argue that the deal is in good shape.
Yeah, effectively argue a force majeure event, that COVID-19 constituted a force majeure, which means that even though you don't end the implementation, you kind of pause the implementation for some period of time. If there was good feelings and good faith between the both governments, that might occur. But as both Dan and Barry pointed out in their presentations, that is not the case. And for the next 6 months till the elections, it's going to get worse. They correctly point out that the Republican position is going to be deflect attention from the failure to deal properly with COVID-19 to blaming China, and the Democratic position is to inoculate themselves against any charges that they're soft on China. One slightly positive note, since this panel has not been filled with optimism, is the businesses that I talk to, the American businesses, suggest that the Chinese are really trying to implement where they can. That I spoke with an energy company, and here you've had this massive drop in energy prices, which of course is going to make the absolute dollar value of those energy purchases substantially lower. But they are trying to kind of get that energy in, and the companies in the agricultural area, the Chinese are, to the extent possible, trying to purchase more soybeans and other agricultural products at this point. So there is some good faith at the operating level. And then at USTR, they say that, again, this is not talking with Ambassador Lighthizer or the deputy, but the working level, that they say the Chinese are trying to implement that and implement the agreement. And in fact, you know, we at the committee talk a lot about channels of communication between the United States and Chinese governments being closed down. What they say at the working level, they are not closed down, that they continue to communicate on very specific implementation of those agreements. Having said that, let me get to a really toxic question. Which is, how serious do you think is the Trump administration in getting China to pay, either through lawsuits of its own or endorsing people suing the Chinese government, or saying China should forgive interest payments on U.S. treasuries, which obviously is a policy which I think we would all agree would be disastrous for America. But how serious is this, Dan, Barry?
It's the hard part is separating statements that are meant to be taken seriously from stuff that's just noise, frankly. And there's not good command and control within the Trump administration senior echelon, I would say. There's not good message control. Famously, there's not. And so, you know, there's a lot of policy entrepreneurship in different departments around Washington, where folks are trying to come up with things that they think will resonate with the Oval Office, or support the Republican effort to deflect responsibility for the manner in which things have been handled in the past 3 or 4 months. And so there are a few things coming out of the administration that I've seen that we actually think merit very careful attention and reflection, that they have some momentum, and that there is actually a sort of implementation process behind them. Some of the things to do with financial decoupling, Steve, which we talked about, and one of the reasons why I had so much to say about that issue is that that's not just a flash in the pan sort of idea that's kind of just being trialed out there and is going to just go away. Some of these other things, opening the door to lawsuits against the government of the People's Republic of China for its handling of the virus, I think are you know, not to be taken seriously, I think, although in as much as people are still trying to get Beijing to pay for Republican era Chinese bonds, maybe 70 or 100 years from now, we'll still see some echoes of this sort of thing. But I don't take those too seriously for the most part.
Barry, anything on that? No.
No, I agreed. This is a provocateur. You know, it's just an effort to get people riled up and get your base motivated.
One of our directors, Bob Peterzak, asks, has the COVID-19 crisis led to a further centralization of economic control in China, or an impetus towards reform? So for Xu Gao and Professor Tu.
Well, I think that in order to recover from the COVID-19 crisis swiftly, I think that Chinese government definitely need to do more, need to use this expansionary monetary and fiscal policy to stimulate economy, and that will naturally lead to more influence of the government on the economy. And I think that is also the trend in other countries, also in United States. But I think that China is also always on its track to push forward the market-oriented reform, mainly in recent years, mainly in the financial sector. For example, we are opening up our financial market to foreign investors, so things like that. I think that so the COVID-19 crisis is just the short-run turbulence, distortions, and that won't change the long-run trend of the China, especially the China's reform agenda.
Professor Tu.
When we fought with the pandemic, of course, the Chinese government was mobilizing the resources around the country. So in some, especially in the medical industries. But to recover the economy or to promote the economic development, I think the Chinese government still needs further marketization. Actually, you may notice in April, the Chinese government released a new document on so-called the marketization of factor markets. It was, as I said, it was released in April. So at least I haven't seen any clear tendency toward more centralization in economic policy.
What about phase 2, folks? Are we ever going to see the beginning of phase 2 negotiation, which was supposed to occur soon after the January 15th signing of the phase 1? So both somebody from the U.S. side and somebody from the Chinese side to answer that. The silence is deafening. No.
I mean, U.S. side, it seems such a distant prospect. It's hard to take it seriously.
Professor Tu?
Well, actually, I don't think that there will be a phase 2 deal in this year, at least. So I think both sides need more time to implement a phase 1 deal first. But as you all know, that right now, implementation of phase 1 deal is facing significant challenges. So I just think that we don't need to start a phase 2 negotiation.
I think that let's first get the phase 1 trade deal done. And the second point I want to make is that we need the two countries need to build more foundations before start negotiating phase 2 trade agreement, because that, when United States always points its fingers on China and always think that China is not doing things right. China is not following U.S. passes, and China is not pushing for market-oriented reforms. If you have that kind of mindset, I think it's very hard to have a phase 2 trade agreement. China will have its own model, and that model may not look like the model U.S. has, but I think that two models can work together to make them these two models they're compatible with each other, I think, from the global perspective, and then before we have a consensus on that, I think it's impossible to have a phase 2 trade deal.
Can I jump in on that?
Sure.
I mean, because it relates to the question of centralization as well. I mean, on the one hand, if we look at sort of economic reform, yeah, China seems to be moving towards additional steps toward marketization. But we also see the party control being so much strengthened throughout the economy, and to be honest, worldwide. And so, when you say there are different models, Xu, to us, it looks like the model is absolute political control combined with marketization. And I gotta say, I worry very much whether that is compatible between the two systems. Because I mean, the basis of, the basis of China's WTO membership, among other things, was that state enterprises would be not taking political guidance, that they would be purely commercial entities. And so I think it's that's the problem that we're, I think, most concerned about on some deep level. So I mean, in a way, I agree with you. It's the fundamental lack of trust rather than the need to move to a stage 2 deal that I worry very much about how that lack of trust can be overcome.
Well, Barry, I think that I agree with you that there is some kind of consolidation of the power to the government in recent years. But I think, in the past 4 decades, China always pushed for its reform in a kind of crossing the river by groping stones model. And so, there is a pros and cons of this consolidation of the power in the country, and I think that if the consolidation of the power is actually that bad, I think that China will shift towards another direction in the coming years. I have faith in that.
Yeah. We just have time for one last question, which is actually a perfect segue into our next panel, which will occur on May 27th at, I believe, at the same time of day, which will have Bob Rubin, Nick Lardy, Yao Yang, and Lu Feng. And it will actually focus on this question, but let's ask the question, which is from Liz Economy, who's the director of the National Committee and at the Council on Foreign Relations. And she asks, if each panelist had the ability to advance and implement one trade or investment initiative in his own country to improve the relationship at this moment, what would it be? So Dan, you had wanted,
Sure.
Either you can answer that and then we'll have to close.
I could go on for an hour, but if I could only have one thing right now, restoring the Industry Advisory Council due process in Washington that assures that U.S. Federal policymaking is done in consultation with industry which understands the realities of whether you can disrupt production and supply chains built up over decades, rather than thinking you could just pull the legs out from under these things. I think I would focus on that.
Barry.
I guess I'd be virus specific, and I'd say let's have a major initiative to cooperate with China, not to cast blame for the origin of the virus, but to pool resources and do everything we can to work together to control the virus.
Xu Gao.
Well, I think the Chinese government should use more expansion macro policy to create more demand for foreign companies, especially for U.S. companies.
Professor Tu.
I think China should allow some social media of America into the Chinese market, at least to Twitter.
So you're repeating the call I make in all of my speeches, which are Google, Facebook, YouTube, Twitter. Please allow them in. It would do wonders for the U.S.-China economic relationship. I'm glad to hear Chinese friends second that call. But I know it's midnight for Xu Gao and Professor Tu, and Dan and Barry have to get on with their days. But thank you so much for what has been a fascinating program. You have our deepest thanks for participating in this. And hopefully we'll get to see you in person, maybe not in 2020, but certainly in 2021. So we'll see you all soon. Thanks.
See you. Thanks.
See you, Xu Gao and Professor Tu.
Bye-bye.
Yeah.